Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's make some money and hopefully get a lot smarter. And I think we will get a lot smarter after this conversation with my next guest. Here with me now is Rebecca Patterson, the former Chief Investment Strategist at Bridgewater Associates. Rebecca, good to see you in person for a change.
I know, it's fun to be here. This is a great studio.
It's not bad, right? We're doing okay here. Well, before I get into your thoughts on the markets and the economy, I think we have a little bit of in common here. You wanted to be didn't you study journalism in school? All these years of talking to you, I had no clue. How'd you end up in managing money and becoming a strategist?
Well, the first beat I had at Wall Street Journal Dow Jones was foreign exchange markets. Ooh. This was back in the mid-1990s. Mm-hmm. And so I had to call traders and analysts and learn those markets, and I fell in love with them. I'm still a total currency geek. I love currencies.
I do have that down on here to talk about.
Currency geek? Okay. So I was in New York and then London, and I was writing for Dow Jones and the Wall Street Journal, and JP Morgan approached me in 1997 and said, hey, we read your stuff. We think you get it, whatever that means, and we want to hire you to be a research analyst. So I joined JP Morgan September 97. So nothing happening at all in global markets. Very quiet period. Yeah. And I was there for almost 16 years. So I fell in love with it.
Why currencies? Of all things that you could be covering, individual stocks. I mean, there was no crypto back then.
No.
Why currency?
To me, currency markets are the intersection of everything, right? Because they're cross-border. Exchange rate is always two sides. So it's always relative value. So what's happening in the US versus Europe? What's happening in China versus Korea? So you have to understand the macro picture for all these different countries. Then you have to understand what's going to drive the capital flows, because currencies are a function of both trade flows and capital flows. So if everyone in the world wants to buy the Magnificent Seven here in the US, even if we have a big current account deficit, which is a negative for the dollar, if all that capital is coming into the US to buy our stocks and maybe foreign direct investment to fund our green energy transition, the dollar goes up anyway. So you have to understand macro, you have to understand micro, you have to understand how the different asset classes are doing. And at the end of the day, it's also psychology. We talk about these things called safe haven currencies for a reason. When people are panicked about the world, they want to go to places that have big current account surpluses, so the currencies have that underlying support. They want to have a really conservative government usually, so places like Switzerland and sometimes Japan work really well when the rest of the world feels awful.
I'm going to really embarrass myself if I got this wrong, but didn't you also want to be an astronaut?
I did. Oh, well, you did some homework
I do
on
some.
me.
Come on, we're not mailing in here at Yahoo Finance, so we do our work. I mean,
yes.
You had to be blown away by what we're seeing in the space race.
Oh man, I would still go up. If someone said, Rebecca, we'll put you on this next rocket, I would tell my husband and kids, I love you, I'll be back, and I would go. So yeah, I grew up in Florida, and I would see the space shuttle literally going across the state as I was driving home from school. And I just thought that was an amazing thing to explore. I've always been someone who wanted to explore, whether that was on land across different continents or in the stars.
It amazes me to watch these rockets go up in the air and watch them land by themselves.
Yes.
The technology behind that, it's just mind-blowing stuff.
We can talk about the pullback in the tech sector or whatever you want to get into today, but at the end of the day, there is this structural trend going on with technology, and the US is so lucky because we have this really cocktail of ingredients that allows us to have this comparative advantage versus the rest of the world, whether it's our educational system that puts out these trained workers, whether it's a culture of entrepreneurship. Some people would like less regulation, but in general, we don't have too much to slow down the innovation. And then we just have these really deep and broad capital markets, which means all these startups can get the capital to go build their dream. And I think all of those things together have allowed us to build this critical mass and this lead against almost every other country in the world. It's going to be very hard for us to lose that advantage. We'd have to screw it up pretty badly.
Yeah. How concerned are you about, I guess, this investor infatuation still about the Mag 7? Mm-hmm. So one of the cool things of working at a newsroom inside of a giant tech company like Yahoo, we got a lot of data. And every day, Rebecca, it is the 10 largest companies. People want to know information about it. They want to see our stock ticker pages, research, interviews with folks such as yourself. And they're forgetting the rest of the market. Is that concerning to you at all?
It is a little, and we've seen this just in the last week or so, that when investors start taking profit on some of their tech holdings, this very small part of the market, because that weighting within the market has grown so big, even if other stocks are being rotated into, it can still drag down the whole market. So to me, that's the risk. If the shine wears off some of these tech stocks, even for a period, even if there's lots of other great companies with good earnings and momentum and better valuations, you could see the entire market pull down. So to me, it does create some vulnerabilities for the U.S. At the same time, to have the pullback we've had in the last couple of weeks, to me feels very normal and healthy. Even with the pullback since the October low, the NASDAQ still up almost 40%. I mean, that's a huge run. People kind of forget, usually 8% a year, 10% a year.
We demand 60% now.
You call
Rebecca.
that a win and go
60%.
home. Right. I know. Expectations, I think, especially among some of the newer generation investors out there, retail investors today, as a part of the total investment community, have the biggest share that we've seen since, ready for this, '07 and '99. Now, it doesn't mean we're about to fall off a cliff as we did in those two episodes, but retail investors are playing a bigger role in the market. And they're generally, not all, but generally younger investors. And to your point, do they realize what is normal over the long term in terms of returns, volatility, exposures? It'll be interesting to see how this plays out.
Maybe you can speak to those retail or those younger investors. What are the mechanics? How does a sell-off like we've seen in tech, how does that happen? What's the trigger point? And then how does it feed on itself? Because most people don't have the inner workings of markets like you.
Well, let me start with valuations, right? So we could be talking about price earnings ratios. We could be looking at how far a stock has risen. But valuation to me is always necessary but insufficient by itself. So in the case of some of the tech stocks, we've seen this huge run, so just the price change, but also very elevated expectations going forward. And you can see that reflected, among other things, in 12-month forward price earnings ratios, PEs. Now, if you look at the PEs today, they are backed by earnings. So this is different than 1999 or 2000 when you had these crazy valuations and no earnings. So I don't think the PE by itself, again, it's insufficient alone, but the valuation, the crowdedness of the trade creates a vulnerability. And then when things are priced so positively looking out into the future, anything that disappoints that expectation could lead to some profit taking, which can feed on itself. One thing I've noticed with this new, again, generation of investors that I think really came to age during the pandemic when they were home, bored, looking for something to do, get a COVID check.
Spending time on Yahoo Finance.
Exactly, as they should.
Yes.
That's a good use of time.
Yes, thank you.
And then going to their Schwab account, E-Trade account, whatever, and putting in some trades. There seems to be a lot more emphasis today on technicals. And I question if there's sufficient focus on fundamentals. So when you see a sell-off start, I think you are seeing more investors falling into that. So, we're below a 50-day moving average. That's a sell signal. Someone said it on TikTok. It must be true. And these things can kind of fuel themselves. That could create more very short-term volatility. But for people like me, I'm more of a medium long-term investor. It's an opportunity. If I can get some of these tech stocks that I think have structural upside, quote unquote, on sale, great. Then maybe I want to actually use it to add to my exposure.
How do you know if they are on sale? Is it as simple, or maybe not so simple, as running a model?
No, you don't know if they're right. So something's fallen 10%. Is that the time to buy? Or should you wait for 15%? Is that the time to buy? This is, again, one reason that I think it makes more sense for most investors to look at the medium and longer term. Because historically, if you can, there's so much good data out there and there's lots of good research reports. You can go on ChatGPT and find them. Timing those pullbacks, timing when to get in and out is a fool's errand. You might as well just go to a casino, have your cocktail by the pool, enjoy it. Yeah. This is the same. So most people will not time correctly. So if something falls 10%, and I think the fundamentals of that company, sector, country, what have you, are attractive, I might want to add incrementally to my exposure. Falls another 5%, as long as my thesis is intact, I'm going to add more. If it falls another 5%, again, if my thesis is intact, I'm going to add more. If something keeps falling, what I have to make sure is that I'm not being stubborn and just buying it because I'm stubborn. I need to make sure the fundamentals driving that thing, that asset that I'm buying, are holding and should, in theory, be looking even more attractive. People make mistakes when they get emotional and stubborn.
Is now a good opportunity
for tech? This week is such an important week with so many of the Magnificent Seven, so to speak, reporting. I know our conversation is coming out Friday morning, so we'll have a lot of that news behind us. Whether they have solid guidance this week or not, I think, again, the longer term, the comparative advantages these companies have, the amount of capital they have. I mean, you think about the free cash flow of these companies.
They're machines.
They can reinvest in their own innovation, unlike any other company around the world. So almost regardless of what the earnings say this week, there'd have to be some huge surprise. I would be looking, if they keep falling, to be adding. Overall, I'd say I'm neutral on that sector right now, again, given positions and valuations. But structurally, looking over the next few years, I want to be there.
What if you are an industrial company? And how do you get the attention of investors in an environment where they only seem excited about AI? But I look at some of these old school industrials, just name a Caterpillar, I'm just pulling out of thin air. Pay a dividend, solid balance sheet, global exposure, maybe the valuation has come in. What's your pitch to investors?
Well, the pitch to the company, and this is somewhat snarky, is put AI into your earnings release because people will Google that and keyword, and that'll probably get algorithmic traders to buy your stock. The real answer for investors is that this is a moment where active investing should work, right? We have higher interest rates. We're later in an economic cycle. Normally, this is an environment where you have winners and losers. When interest rates were near zero, everything went up. So stock picking didn't work. You just bought the index and you wrote it and you won. You had better returns than if you tried to stock pick, or at least that's the data we've seen. So today you're thinking, okay, interest rates are still high. Even if the Fed's about to start an easing cycle, they're still high. I should have more dispersion. It still hasn't worked this year because of the concentrated tech that you had to be in. So you can't ignore that sector, but at the same time, I think there is an argument for active stock picking. There is an argument to broaden out your holdings beyond tech. Whether you're looking at an industrial company, maybe it makes some of the brick and mortars for AI, so to speak, the picks and shovels. Maybe it's an industrial company that's going to benefit from some of the government subsidies flowing through to the economy for chips manufacturing or for the energy transition. So there could be a lot of catalysts for these less exciting companies that could make them winners. I mean, we saw that earlier this year with utilities. Yeah. Usually utilities, you don't even bring it up at a cocktail party. No. People will kind of mock you and walk away.
Which is what we don't want.
And now utilities are hot, right? Yeah. The right utilities, because everyone knows between climate change and AI and the energy needs of the world, we're going to have utilities producing that energy. So the right utilities can be huge winners, and we've seen that reflected in the enthusiasm towards that sector.
Well said. Hold on one sec, Rebecca. We are going to have a quick break, and we'll be right back. So I'm having a really awesome chat here with Rebecca Patterson, the former chief investment strategist at Bridgewater Associates. I loved what you wrote on LinkedIn recently. I do my research.
I see.
You said this, the quote, "The more elections I live through as an investor, the more frustrated I get by election analysis. It's critically important to consider elections in the proper context." I mean, some of this coverage has to be just maddening. I mean, if they win, this happens. If they don't win, that doesn't happen. But that's not how you invest. I mean, what do you make of everything that we're trying to do, I guess, trying to handicap what stocks may do well?
Right. For investors, you have to put all the possible policy changes in aggregate and then in context of non-political factors. So in 2016, there was a cohort of investors who said, if Trump wins, emerging markets are going to get hit, the market's going to go down because we're going to have a trade war. And they positioned for that. And then the market fell for an hour or two, and then it bounced because newly elected President Trump, his first comments weren't about trade. They were about cutting taxes and deregulation. And people had been so narrowly focused on trade. They didn't take all the policies in aggregate. The trade war was net a drag. It is a tax. It is inflationary. However, the tax cuts that were enacted over that time frame and the deregulation enthusiasm that happened overwhelmed it. And so net, the market went up. And so I think this time around, someone will see former President Trump comment about Bitcoin, or he'll comment about tariffs, and you will have some day traders trading that. God bless, good luck to them, that's fine. But for more holistic macro investors, what you want to do is say, okay, what are the probabilities of these policies passing? What is already priced into the market to the degree I can ferret that out? When I put it all together, and then also add, how is the underlying economy doing? What is the Fed doing? What is global monetary policy doing? How's growth in China? That affects the US. Put it all together and then decide how you're going to shift your positions. And by the way, don't do it now. Good grief. We're still 90 plus days away from the election. 2016, really until a month or so ahead of the election, it was Hillary Clinton, done deal. Mm-hmm. And so things can change a lot over these 3-month periods. So I think for people I think what folks can do right now is do your homework, understand the potential policy shifts, try to understand how likely they are, try to get an idea of what's priced in, start figuring out what do I need to do for my portfolio, either to hedge myself, to protect my positions, or what might I want to change incrementally. Get your game plan ready, but don't pull a trigger till we know who won.
Are taxes the most important issue on the table? And hang with me on this one. I had a really cool conversation with Procter & Gamble CEO, John Muller, and I asked him, have the tax cuts from the past few years impacted your business? And he says, absolutely. And they've impacted my business in a huge way. And if you go back and look at their profits over the past few years, P&G has done well. Mm-hmm. Secondarily, I asked him, what if those tax cuts are repealed or not, extended? He says, we will probably invest less in the U.S. I mean, strip away all the election theatrics. Is what happens on taxes probably the single most, contributor to what could happen to stocks in 2025?
That's a great question. It's clearly going to be an important contributor to what happens in 25 and 26 and beyond, yep. Right? So basically, the tax policies that were enacted by former President Trump will be reconsidered next year, and they'll have to say, are we extending all part of them? Or if President Harris, is the person in the office, they might even want to go the other way with some of them, raise taxes somewhat to help fund other spending programs for things like education and young kids. So it is going to be material. Is it the most important thing? Again, I go back to, you have to look at the bigger picture. I don't know what else is going to be happening in 2025. Where is the U.S. going to be vis-a-vis China right then?
Sure.
And we saw an article come out earlier this week from European officials saying that if former President Trump is reelected, if he imposes a 10% tariff on everybody, Europe's ready to strike back with 50% tariffs on key U.S. industries. So, okay, you might think 10% tariff on the rest of the world, that's a big deal, but tax is much bigger deal. Well, if you have a 10% tariff on the rest of the world, plus 60% in theory on China, and you have retaliation from many countries around the world, that might be the bigger deal. We just don't know yet, is my answer.
We've heard a lot recently, mostly from the crypto community, about Bitcoin becoming a superpower. What are your thoughts on that?
So since I grew up in currencies, I have been following Bitcoin closely since it started over a decade ago now, and have written quite a lot of research on private cryptocurrencies and central bank digital currencies, or government cryptocurrencies, if you will. I think they've become a really interesting, innovative sub-asset class, if you will, for speculative investors. I think the hype around them being embraced by longer-term institutional investors is premature. If you are a large pension fund, sovereign wealth fund, there is not enough liquidity for you to put on a position, say in Bitcoin, and then pull it out, take your profit if you're in a stressed environment. Yeah. So those sorts of investors aren't there in size yet. That could change. For now, though, this is largely a retail speculative asset. So for government officials to suggest that we should build a strategic stockpile in
I
Bitcoin.
can't believe that.
Look,
What I'm hearing.
both parties are desperate to get financing in a campaign season, right? This doesn't have to do with politics. This is true across parties. They're looking for who can support them so they can have a great campaign. And in the case of the crypto conference last weekend in Nashville, you had President Trump there, former President Trump, suggesting that he might lean in on Bitcoin. Now, I'm not saying he's only doing this to raise campaign funds. Maybe he really believes this. Maybe he changed his mind from a few years earlier where he said it was made out of thin air. It's possible he just found religion on crypto. Cool, good for him. I think crypto, to me, is still evolving. There's a lot of volatility, so there's alpha, so there's money to be made for investors there who are willing to spend the time in it. I don't think it's yet a mainstream asset class. I know BlackRock has ETFs, other firms have ETFs. To me, that does not mean it's a mainstream asset yet.
You support the Invest in Girls program. Mm-hmm. Maybe you can tell us a little bit about that work and what you're trying to do there.
Oh, I'd love to.
Very important.
For most of my career, when I go into meetings, I'm often the only or one of the only women at the table. And I think that's true for a lot of industries, but I think we all agree that if we have people with different backgrounds, different thought processes, experiences, we're going to have different perspectives around the table. We usually get to better answers. And there's actually data that proves that more diverse workforces have companies that have stronger earnings. So there's math behind it. This isn't just a nice thing to do. It's a profitable thing to do. When we look today at finance, we still don't have as many women in the industry as we'd like. So I chair a board of an organization called Council for Economic Education. We focus on student financial literacy, K through 12. But we have a special program called Invest in Girls that's really trying to do two things for young women. A, teach them basic economic personal finance concepts. What is a credit score? How do I get a low-cost loan for college, et cetera? But then we also want to give them exposure to the industry, take them on field trips, get them mentors. Because once you get into college, you're under so much pressure already. Pick your major. What classes are you taking? We want them to see that this is an option for them before they even have to make those decisions in college. And so by giving them this look on here's what you could be if you'd like in high school, we think that's going to add to the diversity in generations to come.
Is there anywhere someone can go to get more information about that?
Oh, thank you for asking.
Yeah, no, of course.
So Council for Economic Education, CEE, they have a great website with information on Invest in Girls and the other programs that we do. And we're really just trying to make sure that individuals around the country, no matter what their backgrounds, just are better educated so they can be better investors and understand our conversations and make money off it so they can help their families and ultimately help their communities and the broader economy. If we have people who, go back to 2007, if everyone hadn't been flipping homes and taking loans they clearly couldn't afford, we might have avoided 08, 09. That was such a big contributor to that crisis. We need to educate people as early as possible so they can make good decisions for themselves. That'll help their families, and ultimately it helps our economy.
You helped a lot of people in this 24 minutes. That is for darn sure. It's good to finally see you. Rebecca Patterson, former chief investment strategist at Bridgewater Associates. Thanks for coming down to Yahoo Finance. Really appreciate it. Awesome chat. Thank you.
Thank you.
Appreciate it. And that's it for the latest episode of Opening Bid.